Hi, my name's Steve Clapham. Welcome to Equity Multiples number 4. And what I'm going to cover in this video in our Valuation 101 series is all the other multiples that I didn't cover up to date. And this Valuation 101 series is just one of a number of series that we've got on our YouTube channel. Please don't forget to subscribe so make sure you don't miss a video. So we've gone through the PE, and we've gone through the dividend yield, and we've gone through the free cash flow yield. So what I'd like to cover in this video is price to book, PEG, price to cash flow. So let's get on with it. Price to book. I've shown you here OnTex, which is the example we've been using throughout this series. But price to book really isn't used that much now. There's a number of reasons for that. In the case of OnTex, it's not that relevant because most of the book value is goodwill. We've also got this whole issue of we're moved from a world in which fixed assets, factories, machinery, vehicles were important to a world in which intangible assets, your people, your brand, your technology are more important. So the balance sheet has gone out of favor somewhat. But I do tend to look at price to tangible book, not the tangible. So I take the intangible assets out of the equation. Obviously, it's most relevant in situations like financials. So obviously, if you're looking at a property company, it's really important to look at the price to book value, because in those situations, you want to know how much am I paying for the assets. But that's also often true in many deep value situations where stocks have gone to a massive discount. Often the asset value can be an important prop for the share price. So it's important not to overlook that. And you can see here that I showed you in one of the previous videos the R squared, the correlation for PE, and it wasn't very high, the correlation of the PE and earnings growth. But look at this. This is the ROE forecast for a bunch of UK banks and insurers against the price book. And R squared is 74%. That's a very high and very meaningful correlation. So it's a very useful tool for the banks and insurance companies in particular, and also for property companies. Let's now turn to the PEG ratio. And this is a way of calibrating the PE for the growth. The PEG is simply the price earnings ratio over the EPS growth. And you can use PEG 1 or PEG 5. So you can use a 1-year PEG or you can use a 5-year PEG. And generally speaking, if the PEG ratio is less than 1, that indicates that there's some cheapness, some value on offer. This example is Amazon. And what I've shown you here is the Centio printout for Amazon. And you can see that these data are a little bit out of date, so the numbers would be higher today. But the PE for December 18 was 75 times. The 2019 EPS growth, 35%. That's a PEG of just over 2 times. But when you look at a year forward, the 2019 PE is 68.6 times. And the 2020 EPS growth is 40%. So the PEG is 1.7 times. That PEG is high, but falling. So what I'm doing is I'm looking at the PEG today, and then I'm imagining myself a year forward, and I'm calculating the PEG then. So what I would do in a situation like this is I would forecast further out to see that the PEG was continuing to fall, the PE ratio was coming down. And then I would think about how long will it take me before Amazon becomes at a stock market average PE. And that would be my way of calibrating the PE for the growth. Price to cash flow. I mean, this is quite a popular ratio. It's probably less popular and I think less effective than EV/EBITDA. Some people do prefer this to the price earnings ratio. What you're doing here is you're calculating the price and dividing it by the operating cash flow per share. This can be slightly distorted. You've got to be quite careful because if there's some funny movements in working capital in a particular year, the price to operating cash flow can be distorted. And then here's price to sales. This is a chart from John Hussman, Hussman Strategic Advisors. This is the share price over the sales per share. It's most often used for the market as a whole. I think it's a really bad ratio to use. The reason that Hussman uses it, and what he's done here is he's used the median price to sales for the whole S&P 500. The reason he uses it is calculating the EV to sales for the market as a whole is actually much, much more difficult. It's much less straightforward. So people use price to sales as a shortcut. The problem with doing this is sales is the highest number in the P&L. It doesn't take into account any interest or any tax. Therefore, I think you need to look at EV to sales, because looking at the equity component, you're looking at equity component against a business value, because the sales correlates with EV rather than with the valuation of the equity. Thanks for watching. I hope that's been useful. And the next video in our series will be on EV multiples. Make sure you don't miss that.